The smartest investors I know are quietly repositioning their portfolios right now, and what they're buying might surprise you. Because while everyone's still arguing about whether we're heading into a recession, a select group of money managers have identified something bigger, something that transcends economic cycles, an investment theme so powerful that it could define wealth creation for the next 10 years. And here's the thing that nobody's talking about. This opportunity is still in its early innings, but that window is closing faster than most people realize. Now, I know what you're thinking. Another person on YouTube claiming they found the next big thing. I get it. I'm skeptical too, but stick with me for the next few minutes because the data I'm about to share with you doesn't lie. And by the end of this video, you're going to understand exactly why this shift is happening, which sectors stand to benefit the most, and most importantly, how you can position yourself before the masses catch on. So, what is this theme? It's the intersection of three massive trends that are converging right now: artificial intelligence infrastructure, energy transition, and the reshoring of critical supply chains. Now, before you click away thinking you've heard this before, let me explain why this time is genuinely different and why the next 18 months represent a critical entry point. Let's talk about AI infrastructure first, because this is where most people get it completely wrong. Everyone's focused on the software companies, the chat GPTs, and the Microsofts of the world. And yes, those companies will do well, but the real money, the generational wealth, is going to be made in the picks and shovels of this revolution. The companies building the physical infrastructure that makes AI possible. Here's a stat that blew my mind when I first saw it. A single AI training session for a large language model uses more electricity than 100 American homes use in an entire year. Think about that. And we're not talking about one training session, we're talking about thousands of companies running millions of these sessions continuously. The power demand is absolutely staggering. Goldman Sachs recently published research showing that data center power consumption in the United States alone is expected to triple by 2030. Triple. We're going from roughly 3% of total US electricity consumption to nearly 10%. That's not a trend. That's a tidal wave. And here's where it gets interesting for investors. The current electrical grid wasn't designed for this, not even close. We need new power generation, new transmission infrastructure, new cooling systems, new everything. And that creates opportunities across an entire ecosystem of companies that most retail investors aren't even looking at yet. But let me give you a reality check before you run off and start buying random utility stocks. Not all infrastructure is created equal. The companies that win this race will be those that can deliver reliable, cost-effective power at scale. And increasingly, that means they need to solve another problem simultaneously. Which brings me to the second pillar of this investment theme: energy transition. And I'm not talking about this from some political or environmental standpoint. I'm talking about pure economics and physics. Here's the uncomfortable truth that the market is just starting to price in. You cannot power the AI revolution with fossil fuels alone. It's mathematically impossible. Even if you wanted to, even if you didn't care about emissions, the infrastructure simply cannot be built fast enough, and the fuel costs would make the entire endeavor economically unviable. Lazard's latest analysis shows that utility-scale solar is now the cheapest form of new electricity generation in most of the United States. Not subsidized solar, just straight economics. Wind is second, and both are getting cheaper while fossil fuel prices remain volatile. The cost curve has fundamentally shifted, and most investors are still operating with outdated assumptions. But here's what makes this so compelling right now. We're entering a period where demand for electricity is surging, just as we're hitting an inflection point in renewable energy economics. That combination creates pricing power, real pricing power for companies positioned at this intersection. And I'm seeing this play out in real time. Companies that manufacture electrical transformers are reporting order backlogs extending into 2027. Transformer lead times have gone from 6 months to 3 years. Let me say that again, 3 years. When was the last time you saw that kind of supply-demand imbalance in industrial equipment? Now, Some of you are probably wondering about nuclear power right now. Should be, actually, because this is where things get really interesting. Microsoft just signed a deal to restart 3 Mile Island to power their data centers. Amazon is investing in small modular reactors. Google is pursuing similar deals. Big Tech has looked at the math and realized that baseload nuclear power is the only way to guarantee the massive, consistent electricity supply they need. The nuclear renaissance isn't coming, it's already here. And the companies that provide components, fuel, and services to this industry are seeing demand like they haven't seen in 40 years. But we'll come back to specific opportunities in a minute. Let me shift gears and talk about the third pillar, because this one ties everything together: supply chain reshoring. This might actually be the most important piece of the puzzle, and it's the one that mainstream media consistently underreports. The CHIPS Act allocated $280 billion to rebuild semiconductor manufacturing in the United States. The Inflation Reduction Act added another $370 billion for domestic clean energy manufacturing. The Infrastructure Investment and Jobs Act provided $550 billion for physical infrastructure. We're talking about over $1 trillion in committed government spending specifically designed to rebuild American manufacturing capacity. But here's what most people miss: that government money is just the catalyst. For every dollar of public investment, we're seeing $3 to $4 of private capital follow. Intel is building multiple fabrication plants in Ohio and Arizona. TSMC is constructing facilities in Arizona. Samsung in Texas. The total private investment in semiconductor manufacturing alone exceeds $200 billion over the next 5 years. And semiconductors are just one sector. Battery manufacturing, solar panel production, electric vehicle assembly, rare earth processing, all of it is being reshored simultaneously. This represents the largest industrial build-out in the United States since the interstate highway system in the 1950s. Now, why does this matter for investors? Because building factories requires steel, concrete, electrical equipment, automation systems, construction services, engineering expertise, and skilled labor. We're talking about a multi-year construction boom that's just getting started. The companies providing these inputs are looking at revenue visibility that extends well into the next decade. I was recently looking at earnings calls from industrial distributors, and the commentary is remarkably consistent. Backlogs are growing, pricing is holding, margins are expanding. These aren't sexy businesses. Nobody's making YouTube videos about electrical distribution companies, but the numbers don't lie. Let me give you a framework for thinking about how to invest in this theme, because just understanding the trend isn't enough. You need a strategy. First principle: follow the capital expenditure. The companies that are spending billions to build this infrastructure are making public commitments. They're issuing press releases, filing permits, breaking ground on facilities. This information is available if you look for it. And once you know where the capex is flowing, you can identify the suppliers who will benefit. Second principle: look for companies with pricing power. In an inflationary environment, the businesses that can raise prices faster than their costs increase are the ones that will generate real returns. Companies with long-term contracts, high switching costs, or technical differentiation can command premium pricing. Those are the businesses you want to own. Third principle: think in decades, not quarters. This isn't a trade. This isn't about catching a 3-month momentum run. The investment theme I'm describing will play out over 10 to 15 years. That means you need to identify companies with durable competitive advantages, strong balance sheets, and management teams capable of executing long-term strategies. Fourth principle: diversification within the theme. Don't bet everything on one sector or one company. The beauty of this investment theme is that it touches dozens of industries. You can build a diversified portfolio of businesses that all benefit from the same macro trends without taking on single stock risk. Let me get tactical for a moment and talk about specific areas where I'm seeing the most compelling opportunities right now. I'm not going to give you ticker symbols, because that's not investment advice and everyone's situation is different. but I can point you toward the sectors worth researching. Electrical infrastructure is probably the most obvious play, but it's also one of the most crowded at this point. Companies that make transformers, switchgear, and transmission equipment have already seen significant multiple expansion. That doesn't mean they won't continue to perform well, but the easiest money has probably been made. If you're looking at this sector, focus on companies with genuine capacity expansion plans, not just growing backlogs. Industrial gases represent a less obvious opportunity. AI data centers require massive amounts of cooling, and industrial gases play a critical role in both semiconductor manufacturing and various clean energy applications. These are oligopoly markets with high barriers to entry and long-term customer contracts, the kind of boring, steady businesses that compound wealth over time. Rare earth elements and critical minerals are essential for everything I've discussed. You cannot build electric vehicles, wind turbines, solar panels, or advanced semiconductors without these materials. The problem is that China controls roughly 70% of global processing capacity. The reshoring effort requires developing new supply chains, which means new mines, new processing facilities, and new refining operations. The companies executing on this have 10-year demand visibility. Nuclear services and fuel cycle companies are experiencing a genuine paradigm shift. After decades of decline, nuclear power is being recognized as essential for reliable baseload electricity. The existing fleet of reactors is being kept online longer than originally planned. New reactors are being built for the first time in a generation, and small modular reactors are attracting billions in investment. The companies that service this industry were priced for decline. Now they're being repriced for growth. Construction and engineering firms with expertise in complex industrial projects are seeing unprecedented demand. Building a semiconductor fab or a battery gigafactory isn't like building an office complex. It requires specialized knowledge, sophisticated equipment, and proven execution capability. The companies that can deliver these projects on time and on budget can essentially name their price right now. I also want to talk about what I'm avoiding because that's just as important as what I'm buying. I'm skeptical of pure-play AI software companies at current valuations. The competition in that space is intense, and it's not clear who the long-term winners will be. I'd rather own the infrastructure that all of them need than try to pick which chatbot company wins. I'm cautious about traditional automotive manufacturers trying to transition to electric vehicles. The legacy costs, the dealer networks, the cultural challenges, most of them aren't going to make it through this transition successfully. There will be exceptions, but I'd rather own the battery suppliers and charging infrastructure than the car companies themselves. I'm avoiding most residential solar installers because the unit economics don't work at scale and the competitive moat is minimal. But I'm very interested in the companies that manufacture the panels, inverters, and racking systems that all installers need. Let's talk about risk for a minute, because nothing goes straight up, and there are legitimate concerns you should be aware of. Interest rates matter enormously for this theme. Infrastructure projects are capital-intensive and require financing. If rates spike significantly from here, it could slow the pace of investment. That's a real risk. Execution risk is massive in these complex industrial projects. Cost overruns are common. Timeline delays are standard. Not every company will successfully deliver what they've promised. That's why management quality and track record matter so much in this space. Policy risk cannot be ignored. Much of this build-out is being catalyzed by government incentives and mandates. Those can change with elections and shifting political priorities. You need to identify companies whose economics work even with reduced subsidies. Technological risk is always present in rapidly evolving industries. Today's cutting-edge solution might be obsolete in 5 years. That's why I favor companies selling picks and shovels rather than companies betting on specific technologies winning. Here's what I want you to understand. We are in the early stages of a multi-decade investment cycle. The combination of AI infrastructure needs, energy transition economics, and supply chain reshoring creates a perfect storm of industrial demand. The companies positioned at the intersection of these trends have revenue visibility and pricing power that we haven't seen in decades. But you have to be patient. These aren't meme stocks. You're not going to see 500% returns in 6 months. What you will see, if you pick the right companies and hold them, is steady compounding returns over years as these trends play out. The window to position yourself ahead of the crowd is still open, but it won't be forever. Once this thesis becomes consensus, once every financial advisor is recommending these stocks, the easy returns will be gone. We're probably 12 to 18 months away from that point. So here's what I recommend you do today. Start researching. Look at the companies I've mentioned in the sectors I've outlined. Read their annual reports. Listen to their earnings calls. Understand their competitive positioning. Build a watch list. Then create a plan to systematically build positions over the next 6 to 12 months. Don't try to time it perfectly. Don't wait for a crash. Just start accumulating quality businesses at reasonable prices and let time do the heavy lifting. If you found this valuable, do me a favor and hit that like button. It genuinely helps the algorithm show this video to more people. And if you want more deep dives into investment themes and specific stock analysis, subscribe to the channel because I'm releasing content like this every week. Drop a comment and let me know. Are you already positioned for any of these trends? What sectors are you most interested in? I read every comment and I'll respond to as many as I can. The next decade of investment returns is going to be determined by the decisions you make in the next 12 months. Don't let this opportunity pass you by. Thanks for watching, and I'll see you in the next one.